Investing is not as complicated as a lot of people think. Some of the world's greatest investors, like Warren Buffett and Charlie Munger, rest his soul, talk about this all the time. It's not rocket science, and people tend to overcomplicate it. And if you haven't heard of Warren Buffett, at the time of this recording, he's the sixth richest person in the world, clocking in at $145 billion. And he made his wealth as an investor. And in his younger years, Buffett was actually a disciple of Benjamin Graham, who is the author of the book The Intelligent Investor, which this video is going to summarize. Buffett has even gone so far as to say that The Intelligent Investor is, quote, by far the best book on investing ever written. And I would definitely agree with him. I've been using the principles from this book to skyrocket my own wealth in the stock market over the last 15 years. And the first big lesson from The Intelligent Investor is the idea of Mr. Market. So let's say you own a farm that generates a certain amount of profit every year, and you have a neighbor named Mr. Market. And every day, Mr. Market knocks on your door and offers to buy your farm for a certain amount of money, let's say $1 million. Now, the first couple of weeks, the price he offers you is about the same, moving up or down a few percentage points. So you might think, okay, my farm is worth about $1 million. But over the course of several years, you start to notice that Mr. Market is actually not the normal, rational guy you thought he was when he first moved in next door. You realize that he's actually a lunatic who frequently takes complete leave of his senses, because some days you see him skipping with joy on the way to your house, offering you $10 million for your farm. But a couple months later, you see him boarding up the windows to his house, raving like a madman about how the world is coming to an end, and he offers you just $50,000 for your entire farm, which is less money than your farm generates in profit in a single year. And so you realize that when you're trying to figure out the true value of your farm, you can't just take what Mr. Market is offering you at face value. You have to do some type of analysis to figure out the intrinsic value based on real business fundamentals, like how much profit you generate every year, how fast your farm is growing, how fast the price of produce is rising, and other factors like this. And the reason it's important to know this is because Mr. Market is never forcing you to make a deal with him. He's just providing you with an opportunity to make a deal. So if you calculate that based on the business fundamentals of your farm, it's worth $3 million. Then when Mr. Market comes a knocking and offers you $1 million, you can turn him away. And when he offers you $10 million, you can take him up on his offer and sell. And the next year, if you run into him at the grocery store and nothing has fundamentally changed about the farm, but Mr. Market is going on one of his paranoid rants again and is trying to get rid of the farm as fast as possible, you can take him up on his offer again and buy it back at $500,000. Here's what Benjamin Graham is trying to teach you with the Mr. Market analogy. Mr. Market is obviously the stock market. And when you buy a stock like Apple or Google or Microsoft, you're not just buying some ticker symbol on a chart that moves up and down. You're essentially buying a percentage ownership in that actual company. And Graham's philosophy is make your investing decisions based on what price you would pay to truly become a part owner in that company. If little Susie down the street is selling stock in her lemonade stand, which earns $10 a day, and you find out that little Susie is actually selling that lemonade illegally because she doesn't even have a food permit, and all the neighbors are getting sick after drinking her lemonade because little Susie never remembers to wash her damn hands, it doesn't matter if the stock market is valuing little Susie's lemonade company at $10 million. You should know that that's a stupid price to pay to buy into that company. Now, you might think that that's a ridiculous example, so let's look at some real-world examples. Here's a chart of American Express stock. During the financial crisis of 2008, the value of American Express stock went down 75% in less than a year. Now, of course, there was a lot of fear and worry about the financial system during that time, and rightfully so. The financial crisis was a huge deal. But American Express is a huge global network that processes hundreds of billions of transactions every year. Can you imagine trying to start a competing business to American Express today? You can count the number of competitors they've had for the last 3 to 4 decades on one hand. So the idea of that entire global network with all of their business assets having their value evaporate 75% in less than 1 year, some investors might interpret that as Mr. Market going on one of his mad ravings again and overreacting. Investors that just held on to their investment and did nothing would have recovered and would be up 500% today from the previous peak from before the financial crisis. And the people who took advantage and bought more shares at ultra cheap prices when Mr. Market went completely bonkers would be up 2,500% on their investment in just 15 years. That means if you invested $100,000 when the price went to its lowest, in just 15 years, it would have been worth $2.6 million. Now, for our Gen Z listeners, let's take a look at a more recent example, Marriott. During the COVID crash in 2020, the value of Marriott stock went down by 60% in just 6 weeks. Now, Marriott is worth tens of billions of dollars. They generate billions of dollars in revenue every year. They have over 30 brands in almost 9,000 properties across 140 countries. They have the most popular points program for frequent business travelers. It makes sense for the stock price to drop in times of fear and uncertainty, especially since nobody knew how long COVID was going to stick around or how long travel would be locked down for. But a 60% drop in value in 6 weeks? Investors who felt that Mr. Market was getting a little paranoid there and ended up buying Marriott stock after this crash would have made a 330% return on their investment in just 4 years. Graham's disciple Warren Buffett has a great quote to summarize this entire concept. Be fearful when others are greedy, and greedy when others are fearful. And this segues really nicely into the next big lesson from the book, which is to require a margin of safety. Investing is always going to have some degree of risk, but literally anything in life has risk. Sitting inside your house has risk because a plane could crash into it. Holding your money in a checking account has risk because it could be severely devalued by inflation. So risk is a spectrum, and while you can't completely get rid of it, you can do things to reduce it and therefore tilt the scales a bit more in your favor. So let's say you're a civil engineer and you build a bridge, and you use your fancy college education to calculate that this bridge can hold 50,000 pounds without breaking. When you go to the state authorities, you're not going to tell them that this bridge's limit is 50,000 pounds. You're going to tell them that they should not exceed 45,000 pounds or 40,000 pounds because there's always some risk of the unknown, and you want to protect yourself with a buffer, which Graham calls your margin of safety. So when you calculate what you think is a fair valuation for a company's stock, Graham suggests to apply a margin of safety by only buying if the price dips a certain amount below what you think is the right value. He suggests that if you're buying a company's bonds, and if you don't know what a bond is, bonds pay out a fixed amount of interest every X amount of months until the bond matures, kind of like a bank CD. So if you're buying a bond and you're trying to figure out the risk of the company defaulting on that bond, then you should look for a margin of safety where even if business slows down for that company, they have enough financial padding that they can weather a slowdown or a recession and not go under. And this concept of risk management is a recurring theme throughout the book, and it shows up in a lot of different ways because Graham explains how properly understanding and managing risk is a huge part of being an intelligent investor. And part of that risk management process is having a clear understanding of your own personal situation and risk tolerance. Graham says that there's basically 2 categories of investors, defensive and enterprising. Defensive investors encapsulate the vast majority of the population. It's regular people who can follow a pretty standard playbook for investing. Here are some of the strategies Graham outlines for defensive investors. 1. Diversify your investments. Don't put all your eggs in a single basket. Graham lays out some statistics for how many people over-concentrate their investments into just a single company, like the company they work for. This is incredibly risky for a lot of different reasons. Something that's called out in the book's commentary notes is that in today's times, a great way to diversify is with something like an index fund that tracks the S&P 500, which matches the performance of the 500 largest companies listed on the stock exchange in the United States. Which brings us to point number 2, which is to stick with large, prominent companies. If you want to be a follower of Graham's teachings, then unsubscribe from all those shitty newsletters that try to peddle you penny stocks as the next big thing. Large, well-established companies with a long and successful track record are a better place to be according to Graham. And again, you can get exposure to these with an S&P 500 index fund. Point number 3, dollar cost average. This is the idea where you take a fixed amount of money that you can afford to invest every month, and you do it consistently every month without fail, like clockwork. Ken Fisher, the billionaire founder of Fisher Investments, has a famous quote that summarizes this idea really well. He says, time in the market beats timing the market. There's an entire subspecialty of research called behavioral finance that's really fascinating. I'll be doing some videos on it in the future, but there's overwhelming research that shows that humans are notoriously bad at timing the market. Like, you always hear the advice, buy low, sell high, but it's almost like we're hardwired to make poor timing decisions because of our emotions. And so dollar cost averaging takes that psychological disadvantage out of the equation. Now, what Graham calls an enterprising investor is someone who might be more experienced or savvy, and so they might stray from these general guidelines because they have a particularly specialized set of knowledge that gives them an advantage in certain areas of investing. So this could be like famously successful hedge fund managers like Ray Dalio or John Paulson. These guys are not dollar cost averaging into the S&P 500. They have dedicated their entire lives and careers to being extremely savvy investors that can beat the averages. But most people are not professional hedge fund managers, which leads us to the next lesson, which is that the same investment can have different degrees of actual risk to different people. And this builds even more on the earlier lesson of really understanding your personal situation and investing accordingly. The book gives a really good example on this by talking about mortgages. So imagine you have a situation where interest rates are really low, and there's a big housing boom where everyone's trying to buy a house. And you got these two families who each buy a house. In this example, let's say that the two houses are identical and right next door to each other. Now, family one is basically retired. And the town where they bought this house, they grew up in this town their whole lives, right? They have a ton of family and friends in this town. Their kids go to school in this town. So they know with a really high degree of certainty that they're going to stay in this house for a really, really long time, at least 10 to 15 years. And they're happy. They're able to lock in a super low interest rate on their mortgage, super low monthly payments. They're not paying rent anymore. It's a great financial move. Now, right next door, you have family two. And family two is just a husband and wife. They don't have kids. They don't have any friends or family in the area. They don't really have anything tying them to this town. And historically, they've moved cities and states every few years when they got better job offers somewhere else. And they really just bought this house as a type of investment so they could stop paying rent. Now, a couple years later, they get laid off from their jobs, or they get job offers that'll give them a 40% pay raise, but they have to move to a different state to take those new jobs. And obviously, they're going to take them because there's really nothing keeping them in this town. So they have to sell the house. But that year, interest rates skyrocketed. The housing market is way down, and after realtor commissions and closing fees, they actually have to take a pretty big loss on their house. Now, if they stayed in their house for 10 to 15 years, sure, it might have been a great investment, but because of their specific personal situation, where they're forced to sell out of an investment at an inopportune time, what was a great investment for their neighbors was a horrible investment for them, because they had a higher likelihood of being forced to sell early. So Graham argues that this general principle should be applied to your investment strategy. The investment portfolio of a retired widow in her 60s, who's the primary caretaker of her 3 young grandchildren, should probably be totally different than the investment portfolio of a 25-year-old who has a degree in finance and works in the investment industry. Now, interestingly enough, Benjamin Graham and Warren Buffett do have some disagreements over investment philosophy. And one of those areas they disagree on is the idea of buying the stock of companies that you know. So Buffett recommends buying companies that are in what he calls your circle of competence. The idea is if you really know the companies and understand them, you'll be more likely to succeed than if you branch out into areas where you're not as familiar. And this can make a lot of sense, especially from a risk management point of view, because the area where a lot of people get burned is when they start investing in things that they don't understand. They might just be buying those things because everyone around them is doing it. But Graham argues that this buy what you know mentality can actually be dangerous because it leads to a form of overconfidence called home bias, where the more you feel like you already know about a company or a stock, the less likely you are to probe it for weaknesses. He provides some statistics that back this theory up, like the fact that 401k investors keep between 25 to 30% of their retirement funds in the stock of the company they work for. And a lot of investors like this got their finances absolutely destroyed when companies like Enron or Signature Bank just collapsed pretty much overnight. And the people who work there, who had 30% of their investments in their employer stock, saw their money vanish along with their jobs. So now they're out of money and they're out of a job. double the risk. As Graham writes in the book, in short, familiarity breeds complacency. The more familiar a stock is, the more likely it is to turn a defensive investor into a lazy one who thinks that there's no need to do any homework. Don't let this happen to you. Now, a happy medium approach that Graham does approve of is that you can still buy what you know so you don't get burned on investments that you don't understand. But you should simultaneously be following the other principles from the book in parallel, meaning that you diversify instead of putting your entire investment portfolio into just one or two companies. And that you don't get lazy and still do the work to actually analyze the businesses that you're investing in instead of just buying them because you feel like they're good companies since you see them everywhere. Now, if you want to dive deeper into topics like finance and investing, I'm linking some related videos on the screen that I highly recommend, like my summary of Morgan Housel's book, The Psychology of Money. And if you like this summary and you want to see more like it, please do me a favor and hit that like and subscribe button. It really helps support this channel so I can keep coming out with more content just like this. Thanks again for watching. Good luck in your adventure, and I'll see you in the next one.